If you're a beginner investing in the Nifty 50 using index funds or ETFs, I'm sure one of the reasons you chose them was their low cost. But are you making a mistake looking only at the expense ratio quoted by these funds? The real cost of these funds, which say we charge only 0.06%, can be as high as 5 times more. In fact, for some of these funds, it's as high as 1% per year. Hi, I'm Deepak Shenoy, CEO at Capital Mind, where we manage and advise over 2,000 crores in assets, including hundreds of crores in index products, even for the most wealthy people in India. In this video, I'll take you through how you can calculate the real expense ratio of an index product. It's an essential skill if you're a passive investor, and perhaps the only skill you're going to need. Be sure to watch this video all the way to the end, where I'll tell you what my pick is for the best Nifty index fund and the best Nifty ETF. Leave us a comment below on what index fund you currently own and why. What does an index fund do? It buys all the stocks of an index. So what is an index? An index is just a group of stocks grouped together by a certain criteria. And for an example, it could have Nifty 50. Nifty 50 is just the top 50 stocks by market capitalization, the largest 50 stocks listed on the exchange. So effectively the largest set of companies in India. You could have the Bank Nifty, which is the largest set of banks listed in India. Nifty IT, which is an index of all of these stocks in the information technology or IT services space. Now, there are many indexes, but we'll continue to discuss just the Nifty 50. All the stocks, the 50 top stocks, are not given an equal weightage in the Nifty 50 index. They are weighted by a certain separate factor. Let's go through what it means, and I'll take you through the Nifty 50 index page on niftyindices.com. In niftyindices.com has a bunch of stocks, so you can see the Nifty index value, which is roughly 17,277 rupees as we speak, but it contains 50 stocks in different sectors. There's financial services, IT, oil and gas, and so on. The largest stock is Reliance, which is 10.77%. That means if you're investing 100 rupees into the Nifty 50, 10 rupees 77 paisa has to go to Reliance. Now, let's take that theoretically, because it's not exactly that you can invest 10 rupees 77 in Reliance today. But again, that 100 rupees, 9 rupees 23 has to go to Infosys. 5 rupees 10 paisa has to go to TCS, 5.1%. Similarly, if you look at financial services, there's HDFC Bank with 8.5%, HDFC with 6%, ICICI with 6.78%, and so on. These are weightages that will roughly change every single day. So today we're looking at it at this level. Another day, let's say Reliance went up 2%, Infosys fell down 2%. You might see that out of your 100 rupees tomorrow, Reliance is 11%, 11 rupees, and HDFC Bank, which was 8.5%, could be 7.5% because it's fallen. So weightages change every day, and index funds, their job is to ensure that their holdings are in line with the index. Now, the amount of work that an index fund does is largely to keep the weights of their stocks that they own in the same proportion as the index. As you can imagine, this is not a very difficult task. Before we move on, we should look at something called the TRI, the Total Returns Index. Now, Nifty is fine. They tell you what the Nifty is, 17,000, 18,000, whatever the number is. But the Nifty is just a list of stocks that comprise the index. However, if you invest in the Nifty, stocks in the Nifty, the stocks give dividends and there are other corporate actions that happen. When they give dividends, you may receive the money. The Nifty index is adjusted as if dividends never happened. But if you're invested in the stocks itself, you will actually see those returns that come to you. Now imagine you get those dividends and then you reinvest them back into the index. This is what a TRI, a total return index, would be, which tells you what are the total returns if you had received all those interest, bonuses, everything that comes in, and then put that money back into the index itself. Now we'll show you how you can go through a quick way to find out what the TRI means, and this is important because your index funds need to return the TRI to you. Here's how we look at it. Now if you go to the Nifty Indexes site or the website or any other website including the NSE itself, you may actually look at a report called a daily report and look at the archives, the longer term archives of the Nifty 50 short. Instead of looking at the archives or daily returns, you look at something called total return index values. You can select the index that you want, like the Nifty 50, choose 2 dates and download them. For the sake of this video, I have downloaded this already and I'll show you how we can compare them. So I've downloaded the Nifty and the TRI. Let's now look at what they comprise of. I will now show you exactly how the values come across. So I have in column A the list of all the dates and the Nifty at the same time and the total return index for the exact same date. And then assuming we started to invest on 1st Jan 2021, today is roughly 26th Jan 2022, what return would you have received? So you would have started with both as 0%. As you can see, the first 2 dates, the difference is very microscopic. And to illustrate, let me just calculate a difference in the two. So if I differentiate between the TRI minus the Nifty. Now initially it looks like it's 0%, but if I put this across for the whole time frame, remember all these are changes from this value to this value. That means the value of the index at any point minus the value of the index or return from the value of the index at 1st Jan 2021, as if you had invested on 1st Jan and you were looking at your return on all of these subsequent dates. Initially the difference is 0. It slowly starts to increase. Why? Because in the middle some of these stocks are paid dividends. We don't know which ones, but something has happened. Now if I just were to plot this in a chart, a very quick chart that you can see, you'll see that difference keeps increasing over time. There may be some slight differences here and there, and that's just because of some microscopic other calculations, but overall this line keeps going up. By the end of the year, by roughly a year from when we started, the difference is 1.4%. That means the TRI is giving you 1.4% higher than the Nifty itself. The Nifty gives you X. The TRI gives you X plus 1.4% per year, roughly. This is the dividend yield of the Nifty. Now, the reason why we would compare every mutual fund with the Nifty TRI and not the Nifty is because they own the stocks. They don't own a conceptual index. They actually own the underlying stocks. So they receive dividends and they reinvest them. So there is a good reason why SEBI has now said all mutual funds, whether they're index funds or not, every fund has to be compared only to the TRI of the benchmark, the total returns index of the benchmark. This is why now we will look at all index funds and compare them with the Nifty TRI. So we know what a TRI is. So where do you find out what mutual funds cost? Now obviously mutual funds, index mutual funds are doing something. They're buying the stocks in this ratio, they're maintaining this ratio, they're reinvesting the dividends and so on. So they get paid for doing that. Now this payment happens in something called an expense ratio, a total expense ratio, or a TER. A mutual fund tells you its TER is 0.1%. That means for every 100 rupees, 10 paisa out of 100 rupees is paid to the mutual fund company in order for them to have given you an index fund to buy or to sell whenever you want. Which means you're thinking, acha, if the TRI is 20%, that means I've got the index has moved 20% from when I started, then if the expense ratio is 1%, I should have gotten 19%. This is a very interesting point. It's not actually true in India. It's very true in the US, not at all in India. So if you look at the expense ratio, and I'm going to take you through the AMFI website to find out where you can find TERs. It's a very simple concept. You can look at index funds and you can say, okay, can you give me all the index funds in the TER of all index funds as of January 2022. You look here and you see Aditya Birla Sun Life Index Fund, which has a base TER. Now they're very complicated things. There's a TER, there's GST, there's all sorts of things that happen with it. But effectively the Aditya Birla Sun Life Index Fund has 0.59% total expense ratio. There is another, you can see there's a 2 layer over here. The reason there is 2 is because the second one is something called a direct plan, which means there are no commissions paid out of it. The left side is the commission oriented regular plan. The right side is the non-commission oriented direct plan. In the direct plan, you pay only 0.2% TER versus in the regular plan, you pay 0.59. and you can see this of any of all the index funds. So for instance, if I were to just do a control F here and search for the Nifty index fund, this is a Nifty equal weight index fund, so you can find any of them. And a lot of these index funds actually do a different set of concepts. Some of them are Nifty, there's a different set of Nifty indexes. There are different set of, there's a DSP 50, Nifty 50 index fund and a Nifty Next 50 index fund. The expense ratios are different. Each day the expense ratio can change if they want to, but usually they don't change it. This is how you calculate the total expense ratio. Now you're thinking DSP 50 Nifty index fund is 0.41%. Let us search for the UTI Nifty 50 index fund. Nifty index fund 50. So if you look at the Nifty index fund for the UTI, you might say that the expense ratio is 0.3% for the regular plan, 0.2% for the direct plan. Quite interesting. What's the cheapest? Well, there's a fund called Navi, which says its ratio is only expense ratio is only 0.06%. Or if you look at, let us say, a fund called the Tata Index Fund. The Tata Index Fund Nifty says 0.16%. These sound very small. 6 basis points for Navi, 16 basis points. 1 basis point is 0.01%. So 1 paisa out of every 100. This is 16 paisa. And UTI is 20 paisa. So technically, Tata Index Fund should have performed less or should have performed better than the UTI Nifty fund. Logical, but not true. Here's where we look at the index fund costs. There are different costs which apply. What you see here is only one part of the costs that actually apply to you. There's entirely another set of costs. Now these other set of costs come into play in the returns, and we'll calculate this. If we look at the 1 year rolling return of all Nifty index funds, and I've taken just the top, actually not all of them, and I plot them as how far away are you from the Nifty itself, Nifty TRI itself. The UTI Nifty is consistently only about 0.3% less. Now remember, its expense ratio is 0.28%. It's now showing 0.28% as of the most recent date. But even if you looked about 6 months ago, it was only minus 0.3%. That means if the index gave you 10%, it gave you only 0.3% less. The Tata index fund has been as low as minus 1%. That means it was even 1% lower than the index. This is 1 year rolling. That means at any point in time, it was 1 year returns. This is 1 year returns as of April 26. If you were in April 26, 2021, this is the 1 year return that you saw, which was minus 1% compared to the index. If you saw it in September 24th, it's minus 1.09%. If you saw it just a few days back, maybe, or even on 25th of or 21st of January, you would have seen it as minus 0.46. This is wildly varying. Why is this difference even there? And how come UTI can do so much better? The answer lies in execution. UTI's Nifty index fund execution is absolutely the best of all the index funds per se. Now, you may be looking at ICICI. It was great as of Jan 21st, but not so great as of last year. You're looking at a Nippon index fund. Again, they were terrible last year and good this year, slightly better now. But still, when they're saying better, UTI Nifty index fund has still done better. That means despite their expense ratio being 0.2%, you're getting a better return from a UTI Nifty index fund than even from a Tata Nifty index fund, where Tata claims their expense ratio is only 0.16, lower, that is 0.16% in total. This is quite interesting. Why is this even so? The answer lies in a lot of costs that you don't see. So for instance, there's brokerage. Some index funds may be paying a higher brokerage than other index funds simply because of the way they operate. They haven't optimized their costs, so they don't do that quite as well. One of those reasons also becomes the timing of dividend. So for instance, that in a TRI, they will tell you that the stock has paid a dividend today, so you can reinvest it today. That's what the TRI actually does, because there's no idea. In reality, in dividends take a little bit more time to come through. So for instance, if HDFC Bank pays a dividend, it is supposed to be 20 rupees. That 20 rupees is made available to your bank account only about 15 days later. Now, the timing difference of how much difference of time there is between the time they declared the dividend and the time you actually got it in your bank account accounts for a certain difference. What if HDFC Bank declares a dividend, you haven't got the money, HDFC Bank goes up 3%. That 3% is available to you only for the stocks you had invested in, but not the dividend that could have been reinvested as well. So that's a difference that also happens. This typically happens across the landscape. There is also a difference in terms of execution differences. That means I should have bought 8.52% of HDFC Bank. I bought 8.42%. I had inefficient execution. Next day, HDFC Bank went up. That slight differential that I had less of HDFC Bank causes me to underperform the index. This is inefficient execution. There is a third layer. Now, there's a lot of inflows and outflows that come into a fund all the time. Every time there's a new inflow, a mutual fund, an index fund has to buy stocks. When it buys stocks, there is a certain amount of STT, securities transaction tax, that is paid by the mutual fund. Now, when the mutual fund pays this STT, 0.1% is gone. Now, a TRI doesn't know that an index itself doesn't care about STT, right? So it just assumes something has gone from 100 to 110, that's a 10% return. But if you put something rupees at 100 rupees, you've actually paid 100 rupees and 10 paisa for it. And then when it becomes 110, you have a slightly lesser, very marginally, but slightly lesser. So the more inflows and outflows you get that causes you to sell and buy in the marketplace, you pay that much more STT. Now, this STT accounts for a significant percentage of underperformance or overperformance of all of these mutual funds. Why overperformance? It can happen in some cases where you may have a situation where because of STT, you've had to buy less of a stock because that much money wasn't available, and then the market comes down. So you've outperformed by a tiny amount. It can account for that as well. Now, the last part is also the fact that there is a cash drag. That means every mutual fund and every index fund has a certain amount of cash that they maintain with themselves. Maybe it's 0.5% or 1%. That means if you give them 100 rupees, only 99 rupees is invested in the stocks, 1% is left as cash. This is usually used for some extra expenses, the cost of just servicing the funds or keeping the custodial costs in bay. Now, this 1% is a cash drag. So the market keeps going up, you underperform by that little tiny amount that 1%, if it had been invested, would have grown to. So that is another layer of underperformance. Now, how do you offset this? Or how don't these costs occur in the US? US has all of these costs except STT. STT does not factor in over there. And then the US funds do a bunch of things that are very interesting. The first is that they actually lend out shares, and it's possible to do in India as well now, but it wasn't a big market a few years ago. If you look at the US market, they lend out shares for people to short. When they lend out, they take a small fee. That fee can be very tiny, of the order of 0.1, 0.01, 0.02% a year. Now, this fee is received by the fund, and they are able to produce a much lower expense ratio because then they can offset other expenses in the fund. In India, all expenses and income of index fund cannot be taken by the mutual fund company. It has to be given to the mutual fund itself. In India, a UTI index fund regularly lends out some of its shares in order to maintain a higher revenue that allows it to reduce the total expense ratio in that applies to you, which is the real expense ratio. Remember, UTI's expense ratio was 0.20%. Their real expense ratio, the way we differ from the TRI, is only 0.28%. Whereas most of the funds which say that it's 0.16 actually show 0.5, 0.8, 1, as much as 5 or 6 times more than the expense ratio that they actually mention. This is why it's very useful to look at the expense ratio and see how certain funds are actually optimizing their execution. This may sound really small to you, but a 0.3% return and a 0.8% return, that is the difference in return, can be a significant number, maybe 15-20 years down the line. And remember, you got into these funds for the lowest cost. So why aren't you going for the lowest real cost, the lowest impact cost to you itself? So what then is the best Nifty index fund and the best Nifty ETF? We've written an article about this. You can see, we have the link in the description. You can see the description and you can look at this article. It's a fairly deep article on all sorts of things, including what are indexes, why bother with an index fund. It's the cheapest and it's probably the most easy way to get outperformance out of 90% of the index fund universe. Which index fund should I buy, which is not the one with the lowest TER, which is what the fund tells you the expense ratio is, but we look at the different funds and their expense ratios. If you look at, for instance, what Tata Nifty Index Fund says, it was 0.16%, and we've seen as low as 1% below the TER itself. But we've actually seen the expense ratio at different times, and the average is about 0.84% below. So this is fairly large. UTI Nifty Fund Index Fund, its stated TER is only 0.2% and its real expense ratio is 0.31 on average. Now, right now it's a little bit below, but otherwise it's just 0.31%. This is the best. And if you look at the return chart, and our article was written a while ago, but if you look at the return chart as of January 2021. Now, the first two are ETFs and I won't go into those. But here is the UTI index fund consistently outperforming all of the other funds. And the other funds are also interesting. So ICICI Nifty has started to do better, but not even still as close as UTI Nifty. There's HDFC index fund, which is not as good. There is Tata index fund that is mostly terrible, and now it's tried to redeem itself in the last few months or last few weeks. And a bunch of others. SBI's own Nifty index fund. The SBI has an ETF and an index fund. SBI's Nifty index fund is also quite terrible because it's as low as 0.4% below the TRI, which is quite a large expense ratio to take. And remember, in all of these, I've taken the direct funds. If you went with a broker, they would give you a regular fund that is even worse than this. So if you're looking at low cost, choose the lowest cost index fund, which is the UTI Nifty. Now, among the ETFs, and I won't go into details of an ETF, another video will tell you about those. The best ETF is the Nifty Bees by Nippon. Nifty Bees is something you can buy on the stock market, in the stock exchange, consistently performs way better. Right now, it is less by only 0.07%. That means for 100 rupees, you're paying only 7 paisa to be able to participate in the Nifty itself. Fantastic concept. You can go to etf.nipponaim.com. So we'll put that link in the description as well, and you'll see that the indicative NAV on any given date is available to you, because this NAV changes every day. In the middle of the day also, Nifty stocks go up and down. This NAV will change. If you go on a working day, you will see that the Nifty Bees ETF NAV changes all the time, and you can buy it here. The best Nifty ETF is the Nippon Nifty Bees ETF, and the best Nifty index fund is the UTI Nifty index fund. Simple. If you want to participate in the Nifty, don't have to think too much. Lowest cost is what you're looking for. These are the real expense ratios of these funds, and in those funds, the lowest expense ratio goes to the UTI Nifty. The lowest expense ratio on ETFs goes to the Nifty Bees. I hope this video has helped you calculate the real expense ratio of an index fund. It's a skill for a passive investor that takes only 5 minutes. As a beginner, an index product may be the best thing for you to invest in for the least amount of time required. Lots more coming from Capital Mind on YouTube. Hit the subscribe button and the bell icon for updates.